If I show you this stock chart, the first company that might come to mind is nVidia, but it is in fact the stock chart of Rolls-Royce, the UK engineering firm that makes jet engines. So why on earth has a company, part of a wider market that's generally not done much compared to the S&P 500, done a 10x in the last 2 years? Let's see what this funny business is all about. Okay, quick clarification. I'm not talking about this Rolls-Royce, I'm talking about this Rolls-Royce. Wait, what? No. I'm not talking about this Rolls-Royce, I'm talking about this Rolls-Royce. Yeah, Rolls-Royce, the engineering firm, is not the same Rolls-Royce as the car brand, even though their name, brand, and logo is all identical. The engineering company is the one that's on the UK stock market, and the one that's done the 10x. But the car brand is a subsidiary of BMW, a completely separate entity that has their own stock price in Germany. So what's this all about? Time for a quick history lesson. The original Rolls-Royce Ltd made both cars and airplane engines. In 1971, the company hit some pretty serious financial turbulence after they created the actually legendary RB211 jet engine, and then promptly went bankrupt, leading to a government bailout. The aerospace division was separated from the car brand and eventually became today's Rolls-Royce Holdings plc, which makes aircraft engines as well as energy and defense systems, while the car business went its own way and was a sister brand to Bentley, who were both owned by a company called Vickers. Then we fast forward to the late 1990s. Volkswagen bought the Rolls-Royce and Bentley car factory as well as the Bentley brand, but Rolls-Royce plc, the aeroplane engine maker, still owned the Rolls-Royce car brand, name and logo for both the cars and everything else. They then licensed their name and brand to BMW for cars. So, from 2003 onwards, BMW has made all Rolls-Royce branded cars, while Volkswagen kept the old factory, and that's where Bentleys are now exclusively built, which VW owns. So no, a sudden uptick of billionaires buying Phantoms isn't the actual reason why Rolls-Royce stock has done a 10x in the past 2 years. Now you know. So now onto the main story. How did Rolls-Royce Holdings go from struggling to soaring in such a short time? First, we need to talk about how rough things got a few years ago. In 2020, the pandemic grounded flights worldwide, which was a disaster for Rolls-Royce's civil aerospace business. But not because airplane makers stopped buying jet engines from them. You see, Rolls-Royce has something called the power by the hour model, where they earn money from airlines based on hours flown by their engines. So basically, airlines pay a fixed price to Rolls-Royce per flight hour per plane engine, a cost that is very predictable for the airlines, and that's why they like it. And in turn, Rolls-Royce will then service and maintain those engines. Pretty cool. It's basically a jet engine subscription model. But this meant that if something like a pandemic stopped most flights, there was no revenue for Rolls-Royce. So the company racked up huge losses and debt to survive this crisis. Its market cap collapsed to around £9 billion by early 2023, which was a pretty far cry from its glory days. But then we enter Tufan Erginbilgic, a new CEO who took over Rolls-Royce in January 2023 and immediately told everyone at the company that Rolls-Royce was a quote-unquote burning platform that must either transform or die. And not the most optimistic rallying cry from your new CEO, but this was the shock that the company needed. He then moved very quickly to shake things up and created 4 key pillars for transformation, in classic corporate fashion. One pillar was confronting reality, basically making sure that everyone knew how dire the situation was, hence the burning platform speech. Then there was ruthless efficiency. You see, Rolls-Royce had gotten so bloated and so slow that Erginbilgic cut out layers of bureaucracy. In just 2023, Rolls-Royce fired 2,500 staff, mainly made up of middle managers, to basically trim the fat and speed up decision-making. He also held brainstorming workshops with hundreds of employees to get innovation ideas from within the company. He then also set clear performance targets, setting 17 specific objectives from things like improving how long aircraft engines stay on wing and therefore make money versus when they're in repair and are therefore losing money, to hitting things like specific financial benchmarks. He then set a culture of pace and intensity, basically meaning no fanning about, just execute on plans fast and keep your foot on the accelerator pedal. So he essentially told the company to act more like a Silicon Valley startup. And well, let's see what happened next. By late 2023 and into 2024, evidence of a turnaround was starting to become quite apparent. The incredible comeback of air travel post-COVID was a huge boost to Rolls. The hours flown by their engines on passenger planes rocketed up, bringing in much-needed power by the hour service revenue. At the same time, the internal overhaul that was going on was making Rolls-Royce more efficient and financially healthy, to the point where the company actually surprised the market with stronger than expected results. Underlying operating profit jumped 57% in 2024 to £2.5 billion, and Rolls-Royce said it would hit long-term profit targets 2 years early. Investors who once thought that Rolls-Royce might become a permanent underachiever and was a basket case suddenly changed their tune. The company even reinstated its shareholder dividends after a pause of this during the pandemic, and unveiled a surprise £1 billion share buyback program earlier in 2025, basically signaling that it now had a fair bit of cash to spare. These moves lit a fire under the stock and sent Rolls-Royce's share price soaring upwards. But is that the only reason why Rolls-Royce stock has gone so crazy? Well, let's have a look at some other reasons. The first is defense contracts and geopolitics. In the defense sector, Rolls-Royce also found itself in the right place at the right time. With global tensions up due to things like the Ukraine war and an increased focus on higher NATO defense spending, governments have been investing more in military tech. Rolls-Royce's defense division, which makes engines for fighter jets, transport planes, and even nuclear submarine vessels, benefited greatly from this. Rolls-Royce got a boost from the UK's involvement in the AUKUS submarine project. Basically, Rolls-Royce builds the nuclear reactors for Britain's submarines. And the AUKUS deal, a UK and US deal aiding Australia with nuclear subs, signalled more business coming their way. So quite poignantly, war and rumours of war put wind in Rolls-Royce's sails. The next reason is Rolls' nuclear power ambitions. A big factor in investor excitement is Rolls-Royce's foray into nuclear power generation, and more specifically something called small modular reactors, or SMRs. Rolls-Royce leads a consortium developing these kind of mini nuclear reactors as a next-generation power source. Now, for a while, SMRs were just a futuristic, pie-in-the-sky project soaking up R&D money. But recently, the UK government gave Rolls-Royce's SMR program a massive vote of confidence and cash. In 2023, the government shortlisted Rolls-Royce's design, and by mid-2025, as of the most recent spending review from our Chancellor Rachel Reeves, it officially selected Rolls-Royce's SMR to build the first 3 small modular reactors in the UK, with a £2.5 billion contract in the works. Now, this is a big deal. It positions Rolls-Royce as a potential key player in the future of the UK's clean energy initiatives. Investors went positively nuclear on this news, and Rolls-Royce's stock spiked past 900 pence for the first time ever on this announcement. And the market basically cheered at the prospect of decades of revenue coming in from these mini nuclear reactors. The next reason is that leadership and cost-cutting that I mentioned, and the company's general financial health. After Tufan Erginbilgic took over, Rolls-Royce got its house in order financially. On top of jobs and, well, entire divisions being cut, it renegotiated contracts with suppliers and customers to improve margins. And these renegotiations showed up in the numbers. Operating profit for 2024 hit £2.46 billion, up 55% from 2023, with operating margins at nearly 14%. And by 2024, Rolls was in its best financial shape that it had seen in years, and arguably decades. And it achieved something pretty much unthinkable during its dark days in 2020 and 2021: net cash on its balance sheet. You see, at the end of 2024, Rolls-Royce swung into a net cash position of £475 million, up from a £1.95 billion net debt the year before. So that's a £2.4 billion debt reduction in just 1 year, thanks to booming cash flow. So they went from burning cash to making it rain. This new financial strength allowed Rolls-Royce to reinstate its shareholder dividend, which I mentioned a little bit earlier, for the first time since the pandemic, at 6 pence per share, and even announced a £1 billion share buyback programme. Now, investors love dividends and share buybacks, and all of this gave the market more reasons to cheer, and more reasons for the shorters to run for the hills. Then the final reason is positive press and investor hype. You see, as the business fundamentals improved, the story of Rolls-Royce's resurrection took on a life of its own. Media coverage turned increasingly bullish to the point of exuberance. Each upbeat earnings report or contract win seemed to generate another set of glowing headlines. And this sentiment shift basically amplifies any good news when it comes to the stock price. Think a bit like nVidia. One example, when Rolls-Royce crushed its profit expectations in 2024, with those results announced in February of 2025, the stock jumped 18% in one day. And this is when people started really noting that Rolls-Royce had outperformed even nVidia's stock in percentage terms over the prior 2 years. So yeah, a British aero engine maker beat the poster child of the AI revolution in terms of stock percentage gains. All of a sudden, everyone was looking for the next Rolls-Royce in the London markets, and retail investors also started piling in. There's even a Reddit community called r/Rolls-Royce investors. This, of course, is classic FOMO kicking in. The once boring FTSE 100 company had become a momentum stock with a pretty cult-like following. It didn't hurt that Rolls-Royce is also a national pride icon for the UK, so there's a sense of patriotism in seeing a great British engineering company rise up from the ashes. Since mid-2024, Rolls-Royce stock has just been making all-time high after all-time high, and as of now, it touched 5th place on the FTSE 100, its highest ever position, and a pretty remarkable one at that. So, between civil aviation recovering, new engine tech, nuclear reactors, defense, and its own internal changes, Rolls-Royce has transformed itself into a pretty awesome powerhouse. A few years ago, it was seen as a lumbering giant that was in big trouble, but now it's executing on multiple fronts like a nimble, innovative player. And throughout all of this, Rolls-Royce leadership has basically said, we're pleased, but not done yet. This is just a milestone, not a destination. An attitude that's likely reassuring investors that Rolls-Royce keeps intending to push ahead further. Rolls-Royce's stock climb has been nothing short of just astonishing. Its stock price has risen over 1,000% from its low point in 2023 to current levels. A gain normally expected from high-growth Silicon Valley tech stocks in the US, not an old aerospace and engineering firm in the UK. One head of markets described the old burning platform as having been well and truly extinguished, with Rolls-Royce now firing on all cylinders. People who were skeptical, who had written it off, are now eating humble pie, and those who bought in at the lows are most likely grinning like Cheshire cats. So, can we really call Rolls-Royce the nVidia of the UK? These two companies couldn't be any more different in what they actually do or sell. nVidia designs the chips that powers everything from games to AI supercomputers, while Rolls-Royce designs jet engine turbines and mini nuclear reactors. But from a share price perspective, Rolls-Royce has matched and even out-delivered nVidia in this comparison, rewarding the believers and surprising the haters. Both companies took bold bets on the future, so nVidia on AI and Rolls on post-COVID air travel and new engineering and power tech, and they both saw those bets pay off handsomely. The question I suppose we really need to ask is this rise sustainable? And that's where the real analysis lies. Rolls-Royce now has pretty serious momentum, financially, technologically, and in its investor sentiment. It shed its complacency and proved that it can still innovate at the highest levels. It's benefiting from strong tailwinds as air travel is normalizing again and defense spending climbs. Plus, new ventures like SMRs could hold a promise of adding entirely new revenue streams in the coming years. But as always, challenges do loom on the horizon. You see, the aerospace industry can be cyclical. If global growth stutters or airlines hit trouble, for example, the engine orders and service revenues could slow down. And competition is also pretty fierce. US company General Electric and others aren't really standing still in engine technology. and new nuclear startups could also challenge Rolls-Royce in SMRs. Rolls-Royce's recent surge also raises expectations. Investors are now going to expect it to hit those ambitious profit and cash targets consistently, and any stumble will probably cause the stock growth to stall. So, sustaining the high-flying performance will require steady hands on the controls. The good news is, though, is from what we've seen over the last few years, Rolls-Royce does seem up to the task. The company that was once called a burning platform by its own CEO is now a well-oiled engine, running smoothly and perhaps even ready to engage the afterburners if new opportunities arise. But will it sustain its stock market rise? Well, there's a cautious air of optimism, but we'll find out in due course. As stated in this article, there are plenty of reasons for investors to remain positive about Rolls-Royce's future, but the company must keep executing with the same intensity that got it this far. So Rolls-Royce might not literally be nVidia in that it makes AI chips, it's a very different beast, but it has delivered an even better than nVidia level stock surge over the last couple of years, and reinvented itself in the process. And for an old British engineering firm that wasn't doing too well until just a few years ago, that's a pretty good comeback story. And that is, everybody, how Rolls-Royce went from grounded to sky high. If you enjoyed this episode of Funny Business, please do hit that like button. It really does help out a lot. And on some versions of YouTube, whenever I say like button, the like button should actually light up. Try replaying this a few times. So everybody, do you think Rolls-Royce can keep up this momentum, or do you think that there are some clouds on the horizon that might cause it some turbulence? Do let me know in the comments below. And of course, do subscribe to Funny Business as well for more videos on business stories. But for now, click over here to see this video that I think you'll really enjoy.